And I think if one has enough of a time horizon, that's really where the best rate of returns are going to be within the gold space, because you'll have large investors invest in these production opportunities. These gold producers have got the message a long time ago. They're going to run their businesses really well. They're going to make money. Fund flows start coming in there, and in today's world, momentum and program trading starts occurring. That could have such a massive impact within the space that, you know, then we'll be talking about, are we at the top of the cycle? And at some point in time that happens. We're not even close to being there yet, because we haven't seen any major fund flows come into this space yet.
Welcome viewers to this virtual fireside chat with a long-time natural resources investor, Ryaz Shariff. Ryaz is principal and portfolio manager at Primevest Capital, which is a specialist investment manager focused on the natural resources sector based out of Canada. Ryaz, a very warm welcome to you.
Oh, thanks for having me.
Yeah, thanks for joining us. And it's great to have a discussion with you to get into some of the topical themes and your steer on investing in the natural resources space. And with that in mind, I just wanted to start with how you found yourself investing into early stage growth stocks in particular, and how you became an investor yourself.
It's a good question. That goes back a long ways, and I guess the background really is that I'm a mathematician. So I was formally educated in mathematics, and I wasn't anticipating on going the investment route, but rather the actuarial side of things. That opened up the investment world to me, and realized that was more of a passion, because I had been investing since I was a teenager. So I got my start originally in the brokerage business with one of the Canadian bank-owned firms, but it didn't feel like it really was a great fit for me, because we had that entrepreneurial spirit and the entrepreneurial blood that required us to expand our wings. So I started in the brokerage business. We shifted from going from a conservative portfolio management area into some more exciting opportunities in the growth space. And then I took a pause for about 8 years in that career path to actually go and operate various businesses. And these were all reasonably early stage businesses, where it gave me a very good handle in terms of what it took to actually run a business. And then ultimately I came back and got into the portfolio management side of things.
Yeah, excellent. So running those businesses, that's quite interesting, because that's sort of giving you maybe an advantage, if you like, if you're an investment manager looking at companies, thinking about your time on the corporate side, that puts you at a bit of an advantage, I suppose.
Well, what it does is that most portfolio managers have gone to school to do some sort of business or financial degree. Then they get into the business directly, and then they've only got the financial experience. And the difference is it's very difficult to run a business. And when you go through that process, you understand all the intricacies in terms of hiring and firing people, in terms of motivating your employees, in terms of what happens on the shop floor.
Yeah.
And what that does, it makes you a better analyst in terms of understanding what the risks and the opportunities are in the investment process. Everything from just the interaction from a CEO and a CFO sitting in your boardroom will give you an indication of how that relationship is and how that can manifest itself in success or failure. And so having that background by operating businesses, I think gives you a certain significant edge as an investor.
Yep, absolutely. Okay, so let's turn to Primevest Capital then. Could you first give sort of introduction to Primevest Capital, and then also I'd like to ask, why focus on natural resources? How did that evolve, or why did you set up specifically towards natural resources?
So Primevest Capital, its flagship fund, the Primevest Fund, has been around for about 16 years now. And the major focus is certainly in the natural resource sector, but not exclusively. We do things outside of the natural resource sector, and typically growth stories as well. The area of natural resources in terms of our involvement became, from my background, as being based here in Vancouver, we have a significant technical and financial expertise within the natural resource sector, particularly in mining. In Calgary, we have a similar expertise within the oil and gas side of things. And so when you get involved in the capital markets in Canada, that's always been a significant portion in terms of the opportunities. And the other aspect generally has been Canadian banks and financials. So it was gravitated to that because of relationships and because of expertise.
Yeah, absolutely. And you just look at, in terms of your sort of investment scope, you just look at Canadian companies, and TSX, TSXV, that kind of thing?
Well, we don't necessarily have a mandate strictly on natural resources or strictly in investing in Canada. But because of our view in terms of how to invest, which is being close to management, most of our investments are Canadian listed companies. Their assets may not necessarily be in Canada, and in most cases they're not. But all of the management teams are usually close to us, either by jurisdiction or a relationship that we have that we can connect very closely. So we've invested in the US, of course. We've invested in Australia, which has similar type of profile as a number of the Canadian natural resource side of things. And we've invested in other markets in the world. But our primary focus really is in Canadian listed public companies.
Yep. Okay. So with your funds, then, what's the sort of the sentiment for Canadian listed natural resource companies now versus perhaps how it was a few years ago, in terms of the sort of family office, high net worth, and some of the institutional investors that you have as your clients or in your network?
So first and foremost, our investor base is primarily friends and family. And some friends and family would have their own family offices, but we don't actively do any marketing. So it's a reasonably close-knit group of investors, and a number of these investors are also some of the entrepreneurs that run a number of these natural resource companies or other non-natural resource companies that are investors alongside us. So it becomes a relationship as well, and I think together, and because of the history of the longevity of these relationships, and to be able to help some of these companies progress in their evolution as well.
Mm-hmm. Okay, so you've been the fund's been going for 16 years, I think you mentioned. What you've seen the markets move then? Where do you think we are perhaps now then in terms of the commodities cycle? Do you think that this could evolve into another super cycle as such, or do you think that's perhaps a little bit premature to be saying that, and we're more of a sort of a cyclical bull run in certain metals and certain commodities?
Yeah, I never feel comfortable calling anything a super cycle or just a cycle, and you really only know at the end of it whether it was a super cycle or not.
True.
Where are we on it? Well, the natural resource sector is certainly a cyclical business, and in my view is it's typically every 5 to 7 years this happens, and if it's 7 years, then the cycle will last a bit longer, and if it's 5 years, the cycle will be a bit shorter. So I think there's no doubt we're in the upswing of this cycle. How long does it last? I think there's some fundamental arguments that we have at least a couple of years in this cycle, and we can talk in more detail But I think if one's like your clients, the family offices, if you've got asset allocation decisions to make, commodities and commodity equities representing commodity investments are a requirement to have at least 5 or 10 or 15 or 20% of the allocation today in that area.
Yeah. Okay, that's interesting. Yeah, and perhaps that's up from what it was sort of 5 years ago, or the middle of the last decade. So you're primarily small cap focused, as far as I understand, and that's perhaps where you see better returns, better margin. But tell us your investment philosophy, and how you look at small caps and what you look for in terms of their attributes for your fund.
Yeah. So again, because we have no restrictions in terms of the criteria of what we invest in, or including market caps, we invest through the whole side of the spectrum. But we find that we can add the most value in the small and mid cap range. So with any investments, we basically have three criteria that are the most important. Number one is management. We believe that if you're investing in the public markets, the stewards of the capital that you're providing to these public companies, the management is the most important part. And in our belief, that 85% of the risk mitigation in your investments comes from that one very significant factor. So management is important for us. It's important for us to have relationships with management and accessibility to management. It's also important for us to have management that's vested in these companies, and that they have a significant incentive to make sure that the business enterprise is well.
Yep.
Number two, when we make investments, we look and make sure that we have a fundamental undervaluation within our investment process. In addition to that, we typically want to see some other blue sky potential within that opportunity that's not that you're not paying anything for. Okay, so you can expect that if you're seeing those type of opportunities, you have to do a lot of rigorous research, which is what we do to try to identify those things. And thirdly, and as importantly as maybe the second, but not as important as the first criteria, is that it has to have broad institutional appeal at some point in time in the next 12 or 24 months or 36 months, depending on the type of investment it is, because ultimately the fund flows determine the multiple expansion opportunities. So within that context is what we typically look in our investment profile. And as a result of not being able to find so many of these things, we run a reasonably concentrated portfolio.
Yep.
And our top 5 holdings typically 40 and 50% in normalized times. So that impacts some of the volatility that we have in our fund. And that's why a lot of our investors are friends and family, because they can understand the long-term opportunities here. But we typically have long-term opportunities.
Yep, certainly. I think very much needed for the resources space. Within that, though, how do you split between sort of metals mining and then oil and gas? The pedigree of oil and gas in Calgary versus the quality of mining companies on the TSX, TSXV.
Yeah. So, it's a fine balance between a macro and a bottom-up approach. I would say the majority of what we do is bottoms-up approach, and then we can overlay some sort of macro views on things. History in the hydrocarbon space really is that when at the early stages of the fund, we rarely invested in the Canadian domestic oil and gas space, even though we had relationships and opportunities here, because we found that a lot of those, the most inefficient opportunities existed actually in the international space. So places like the North Sea, offshore Gabon or West Africa, India, Australia. We saw some really significant opportunities there that met all of our criteria because we had relationships with management. They were highly inefficiently priced and they were undervalued, plus had the blue sky opportunities. But ultimately, large enough enterprises that it actually would ultimately get bought out by larger players. And then when we started seeing inefficient opportunities within the Canadian domestic oil and gas space, we entered there. But generally speaking, we've been out of the oil and gas space for about 5 or 6 years, other than a couple of investments. And today, we probably only maintain one US-based investment and a couple of natural gas investments because we think there's a significant opportunity from a valuation standpoint and a dynamics standpoint within the industry, including LNG. So today, we're more mining focused and the least oil and gas exposure that we've ever had. And we can discuss that in more detail. And then we also have other investments outside of the natural resources sector as well.
Yep. Yeah, okay, we can go into that. But first, I wanted to come back to something you were saying about management. Obviously, fully appreciate your points there. And this is something that I've heard a few times. But what exactly within the management, you asking? You're talking about track record here. Are there any other factors or attributes that you really look for?
Yeah, in the public company world, you often one of your biggest decisions that you need to make is what is the management telling the market, what the management telling you, and how much can you trust that management team? Yeah. And because there's so many different public companies out there, and a number of different management teams, sometimes management teams don't have the investor's best interest at heart. So we find, and to a certain extent, it's a function of how the public markets work. And so, what our clients pay us for is to not have that risk. So track record is immensely important. Investing is important, but the way we look at things is we rather have an extraordinary management team and a mediocre product than the reverse. What tends to happen with these extraordinary management teams is that every business goes through hiccups, it goes through issues externally or internally, but the teams that have the track record of success figure the ways around things. And so by being a long-term investor and understanding the ups and downs of that market, but the management is being upfront with you, then it gives you an opportunity to say, well, that's a big risk that I've taken out of the situation. Everyone understands business risk that happens, but how do you deal with that business risk, and who has a track record to be able to come out of the other end of that successfully?
Yep, absolutely. That makes sense. Perfect sense. Coming to your point then around there's a lot of public companies out there, and there's a breadth of quality perhaps, or certainly a lot for you as an investor to filter through. How then do you cut through the noise of a sort of a bullish commodities market? Are you finding that there are a lot of promising projects that once you get under the hood, there's very few that have these attributes of the management team and the asset in the sweet spot where you want it to be, that's actually still under the radar of the public markets and the larger investment banks, that it's in that sweet spot that you described, with still some blue sky opportunity, I think you said.
Yeah, so let's sort of talk about I talk about the integration of the bottoms up and the macro. So let's talk about copper. Copper is topical today.
Yeah.
We did a a very detailed analysis of the copper market about 2.5 years ago, and dug deep down into it. And we, because of our longevity in this business, we also have a significant network everywhere from miners to suppliers to refiners to people on the ground in China. And so when we did this full Monty of a copper market, we look at things like supply demand, and we look at mine by mine supply and go through all of the mining producers in the world, plus the probable projects that come on stream, plus possible and expansion opportunities. And then we look and make certain assumptions on the demand side of things. We look at what the refiners are doing in terms of the treatment and refining charges, which gives you an example of, or gives you an indication of how tight the concentrate market, the miners providing product to the refiners, what that looks like. We look at things like premiums that are paid. We look at inventory levels. And so we actually came to a very bullish conclusion on this, and we were pounding the table on it about 2.5, 3 years ago, because it seemed so obvious.
Yeah.
But then what happened soon after we made that publication, about 2 months later, President Donald Trump basically imposed trade sanctions to a number of parties in the world, particularly China. And that basically stalled all progress on the market and the copper side. So what we're seeing today, or we've seen in the last number of months, is exactly that analysis and that opportunity that now is eliminated that other external factor. And so in the copper space, it's quite evident to us that this is a long-term opportunity. Why is it a long-term opportunity? Because we have a demand that's being driven by multiple things, and the EV is certainly a topical part of that, and that's going to be a significant portion. But what people have to understand in the mining business is mining is a very difficult business, and mining multiple activities in there that that can impact operations dramatically. But the most important thing to understand is that it probably takes, in today's world, about 10 years to go from a discovery to production of a reasonable sized copper mine. Okay. And so, and a lot of that, if we would have having this discussion 15 years ago, that number would have been 5 to 7 years. And so, tack another 3 to 5 to 7 years additional because of environmental restrictions and issues around that, social issues, and then grade issues as well. Okay, so now, when we look at things, and where do we see the best opportunities within the copper space, for example, like you were asking. So one area that we like to focus on, that we think has the best reward to risk ratios of almost any type of investment in any market, is advanced stage development assets, particularly in the copper porphyry space, and particularly in those world-class or sub-world-class discoveries and opportunities. Okay? Why do we think that there's such a big reward to risk ratio on it? The reason for that is there's not a lot of technical expertise within the investment world in these type of deposits. And so how we approach these is that we look, and so we're not looking at early stage exploration, which is high risk, necessarily looking at production stories, which basically is exposed to the day-to-day fluctuations in that commodity price. What we're looking at here is we're looking and saying, we've found a deposit that we think has some sort of economic value before any independent economic studies have been completed. So we have that expertise, and we have access to the expertise to evaluate those opportunities. Then we look for a management team that has a financeability and the expertise technically to de-risk this project, to expand this project, and then ultimately by those two very facts, we would end up having a multiple expansion opportunity. So in these type of opportunities, we would like to buy these things at anywhere from 0.05 times to 0.15 times NAV. Okay, and then what we want to see is that NAV expands due to the technical expertise and financeability of these management teams that have strong track records. And then as it de-risks, that multiple expands. So we end up seeing an expansion of multiple, an expansion of NAV, which ultimately results in anywhere from a 3 to 7 to 10 bagger over a period of 7 years. That's what we typically look at. And are there many out there? No, not a lot. But the opportunity is twofold. Number one, a lot of people and investors don't necessarily understand the merits of this at that stage. And then the second part would be that they don't understand the merits of this, and they don't have the access to that opportunity. Okay, so that those areas is an area where we think that is very unique. Ultimately, what happens in the natural resource business is that the producers are always dealing with a depleting asset, and they're always pressured to grow and provide some sort of shareholder return. So these ultimately, over that time frame, typically get consolidated within those larger companies. In the copper porphyry space, our view is that there's not a lot of assets out there, that even though there may be a lot of public companies doing exploration and development work, there's not a lot of assets out there that will actually be mines. And those are the ones we try to search out diligently.
Absolutely. And yeah, you sort of answered my next question there, was going to be on the sort of number of companies that you found were in that sweet spot that you've carefully explained there. But just coming to copper though, do you think that there's more recognition now with something like the energy transition going on from a broader investor base, or more investors to come to you and say, hey, look, I'm interested in copper because of what's going on, because we're moving away from hydrocarbons to electrification? Is that that's going to be positive for the amount of capital that the miners need to sort of increase the amount of copper coming online in 5, 7, 10 years?
Well, you've hit the nail on the head, because what's happened now is we're in a very unique position in the world. That is, there is a secular opportunity occurring here that's going to see the transition of energy. And so this is a secular opportunity that we really haven't seen in this market, in this copper market. And so the EV argument is such that it requires probably about 4 times more copper in an EV car than a typical internal combustion engine car.
Yeah.
But more importantly, or as importantly, is infrastructure to deliver that electricity to those EVs, which includes charging stations, but also additional copper wire in your house to charge your car. And then, of course, where are you getting that energy, and how are you transmitting that energy to the end users? So we have a secular opportunity that's going to have a significant demand driver within the copper space at a time where you saw over the last 10 years a significant reduction in investment in new mines and opportunities. And so will it catch up? Yeah, it always does. The commodity markets always catch up. But in my view, there's going to be a bigger lag today than there has been in the past, for the various reasons I outlined at the beginning of our chat.
Yeah, that's interesting. It's and just thinking about the metals that are set to perform or do well on this secular opportunity as you describe it. What other metals are you confident on other than just copper?
Well, I think if you're looking at this EV space and the secular opportunity, the first thing you have to understand is battery chemistry.
Yeah.
Uh, so about 3.5 years ago, I went down to Tesla's facilities in Fremont, California, and I had the opportunity to spend a number of hours with materials engineers there. We wanted to try to understand their technology roadmap for their battery program, how they saw the upstream part of the business. And we wanted to understand also what they believe to be substitutable minerals and ones that are not.
Right.
We got a pretty good handle in terms of what Tesla was looking at. Then subsequent to that, there's been a number of other parties, particularly out of China, that have been focusing on battery production and battery chemistries. So the first thing you have to do is understand what battery chemistries, particular users and battery manufacturers are using. And so as of today, lithium is an important component to that because that's the electrolyte of the battery. So that's not going to change. Then you look at the anode and the cathodes. Okay, so it seems to me nickel will be an important component because of its energy density abilities. At the time when I was at Tesla's facilities, it suggested to me that graphite was an element that you could synthetically produce, and that the natural graphite wasn't something that was going to be a constraint. Now, having said that, we haven't done much work on graphite as a result of the earlier work I had done, but recently I met with a graphite company and we looked at that graphite's side of things, and it looks like there may be some benefits in terms of a cost standpoint from having natural graphite over synthetic. Right. So, but not something that we've made an investment today in graphite. So then you look and say, what other minerals in there? So lithium is important, nickel is important, cobalt should be important and can be important, but because of the geopolitics around cobalt, I think there's a lot of effort currently undergoing to try to engineer cobalt out of it.
Yeah, certainly.
One area that we've recently made an investment on that we think that could be an interesting component to this is manganese. And there's very few and hard ways to play manganese. And we've made an initial investment in an opportunity. And as we're doing more work on it, we think we may actually make a much larger investment in that space. So I think if you look at the battery chemistries, you've got things like, when we were down at Tesla, it was NCA. Now, everyone is talking about NMC, what portions of NMC. NMC, of course, is nickel, manganese, and cobalt. And that's typically the dream chemistry is nickel, manganese, cobalt, and the 811 portions. Okay. Well, once you start understanding that, then you have to say, well, what are the opportunities in the upstream side of things? What are the battery manufacturers doing in terms of trying to get upstream opportunities? What are the car manufacturers? Volkswagen has become a significant player now in terms of advising and understanding how to deal with the supply chain all the way down to the ultimate miners. This is a secular opportunity. There's going to be lots of opportunities. There's going to be lots of volatility. But if one is prepared to use our type of criteria in terms of management, undervalued nature plus blue sky, and that ultimately it's large enough to garner institutional interest on a widespread basis to get multiple expansion, then over time, there should be some significant opportunities to make multifold returns on your investments.
Yeah. Fantastic. Yeah, it's a constantly evolving space in that respect. In terms of, you probably find you're constantly reacting to the updates on battery chemistry. It's very fast moving in terms of what's going to be perhaps the dominant, or we talk about solid state. Perhaps that's for the next decade, but that again changes the outlook quite dramatically for which metals are going to be in which demand.
Battery space is moving very quickly, and you're right. The solid state is going to be another interesting area. And I was on a meeting yesterday with Ganfeng, the largest basically battery manufacturer, and it has the largest capacity in the world today.
Yeah.
The roadmap is showing a solid state lithium battery. So they're going to use lithium in a ceramic or metal form to get that solid state. But you're right. So there's a lot of moving parts here. There's going to be a lot of changes, but I think if one wants to capture this market in the lowest risk possible and not to deal with all those battery chemistries, it's very easy. Just invest in copper.
Yeah.
That'll be part of the whole system anywhere.
Yeah, certainly. I've heard that good quality copper projects are hard to come by, but everyone's bullish on that, which is great. Looking beyond the transition metals, or the battery metals, if you like, do you also like precious metals? Are you interested in exposure to those? Do you balance the portfolio with other metals juniors?
Yeah, so precious metals and gold in particular is an interesting commodity. We always have an exposure to gold, but that really is driven by our bottom up as opposed to macro. Okay. We will never make forecasts on gold prices.
Yep.
Okay? In my over quarter century of investing in this space, there's probably been only one analysis on forecasting gold prices that has ever, to me, been credible. It was published in the CFA magazine about maybe 7 or 8, maybe a decade ago, that basically looked at all of the ingredients in a regression analysis in terms of gold prices and everything that you would expect, obviously demand, supply, inflation, anticipated inflation, store of value. And after this very thorough statistical analysis, what it spit out was that it's momentum trade. If people believe in it, it will go up, and if people don't, it'll go down. Now, having said that, there's always a base value for a commodity like gold, and that's the marginal cost of production. Because if you don't have that, then then you just won't be able to produce gold economically. So there's that downside protection of marginal cost of production. About 2 or 3 years ago, when Bitcoin came into the scene, I would get calls and people asking me, well, is Bitcoin going to replace gold? And I said, there's no way that's going to happen.
Yeah.
About 8 weeks ago, maybe 3 months ago, I changed my tune a bit, because for the first time, what we've seen is large capital allocators start allocating fund flows into Bitcoin and other cryptocurrencies, but particularly Bitcoin.
Yeah.
Most of those allocations have come from gold.
Really? Yeah.
So that's the anecdotal. We do, because of our networks, anecdotal evidence is very important to us in terms of understanding trends and opportunities and risks associated with everything that we do. Does Bitcoin replace gold? I don't think so. But at the end of the day, all of these commodities are driven by fund flows. And actually, any investment opportunity is driven by fund flows. So we've seen that. it has been cannibalizing gold to a certain extent. Does gold have a store of value? Absolutely, in my view. I think it'll vacillate back and forth in terms of that sentiment, and gold typically is valued differently at different times by different ingredients.
Yep.
My view today is that what's driving, or the prominent feature of gold valuation, is based on real yields. That is what the market is focusing on today. I don't think it's focusing on inflation today, but it may in the future. But that also obviously incorporates a real yield. But right now, the correlation of any other aspect is actually in real yields. The store of value may come current, not, and Bitcoin could be different tomorrow than it is today because there's impositions of government restrictions on that side of things. So we don't know how that's going to work, but what I can tell you today, that the fund flows are coming into cryptocurrency. Some of that fund flows is coming at the expense of allocations to gold. Having said that, like I said earlier about these advanced stage development opportunities in copper, where the daily fluctuations in copper price don't affect this project, but ultimately impact the sentiment when it gets bought or sold, depending on where it's at. We look at opportunities in the gold space from a valuation standpoint. Okay, the gold equity market today is a very different marketplace than it was 10 years ago. We've gone through a decade where there was a lot of pressure from investors to have these gold companies become accountable and operate as real businesses, as opposed to some other or unique sector out there that wasn't responsible for making money.
Yeah.
Today, we're in a position where producers are the healthiest they've ever been. They're accountable businesses, and I think they're garnering interest from real institutional investors based on businesses,
Right.
as a business to invest in. And so my view is we will see in these type of environments, gold price be at reasonably elevated levels. We will see producers be disciplined and return cash to shareholders. They will be running their businesses as good businesses. They will not sacrifice profitability and that good business seal for the sake of growth, for its sake of growth. But we have to be realistic and say all of these businesses in the commodity space have declining asset bases and declining reserves. So there has to be some replacement in reserves. My view is, as these producers continue to run their businesses as good businesses, it will be at the expense of exploration opportunities to grow their internal reserve base. So there will be efficient explorers and developers out there that will create value over time for other gold deposits. And those gold deposits will ultimately be bought by these producers. And so we used to have something like this in Canada many years ago called the income trust model in the oil and gas space, where basically you had these producing oil and gas companies that would provide a predictable income yield to their investors. And it garnered a lot of income investors as well as a lot of institutional investors. They would distribute a big portion of their capital out to those investors, but they had to always make sure that they had a reserve life index of their asset base that would be double digits for them to be able to attract the investors over long periods of time. So what would happen is you would have these really wonderfully savvy entrepreneurs that would start up new businesses and they would get to 5 to 10,000 barrels per day in production, and that would fit the mold of one of these income trusts, and then they would come in and scoop them up. And so the real opportunity in that market became for those entrepreneurs and those investors that invested alongside these entrepreneurs that would make their significant returns. And that's where a lot of the wealth was created in Alberta and Calgary, is by these entrepreneurs. So I think while it won't be the same metrics necessarily, I think that could be an interesting area to be focused on in terms of these developers, where now in the mining business, it takes a bit longer in terms of the life cycle because of the environmental restrictions, the location of these projects, because these opportunities typically occur not just in your backyard, but all over the world. Mm-hmm. But I think what we're focusing on in those opportunities is in these development stage projects where we have management teams that have the track records of doing this before. And I think if one has enough of a time horizon, that's really where the best rate of returns are going to be within the gold space, because you'll have large investors invest in these production opportunities. These gold producers have got the message a long time ago. They're going to run their businesses really well. They're going to make money. So here we don't have to forecast gold prices. Would I be surprised if gold prices 2 months from now are at $2,500? No, absolutely not. Would I be surprised if it's at $1,000 or $1,200? Well, maybe not $1,200. Let's say $1,400. I wouldn't be surprised. That's the nature of the gold market. But these assets that can show economic return to these producers, I think that's some significant opportunities, and that's where we choose to invest in that sort of advanced stage development assets. No different than what we do in the copper space. Now, we do have producers. We invest in producers, but we invest in producers that are undervalued, regardless of where gold prices are going. And so that's the way we typically look at things, as opposed to being put on the spot about forecasting where commodity prices go, because gold is very difficult, as I previously mentioned, whereas copper is based on, or other minerals like copper that are industrial metals, it's based on demand supply, and it's reasonably easy to forecast what the demand supply looks like and what the range of copper prices will spit out. Gold doesn't work that efficiently from that standpoint in terms of analysis.
Yep. Excellent. Fascinating. Picking on one of your points then around this conflict with the corporates between growth and running a really tight ship and returning cash to shareholders. We've seen some of the producers returning dividends, which is great. They're looking broadly undervalued from what I've heard from other interviews. But, how do they replace the mined ounces? Are we going to see a hell of a lot more M&A really soon? What's your thoughts on the growth versus M&A?
M&A is required. It has to happen. But how widespread is it going to be? That's going to be difficult, because you got to look and say, how many really great projects are out there? So I happened to be at the conference when Barrick and Randgold and Newmont were all dealing with the mergers. And, at that time, we basically, and Goldcorp, of course, and we saw the larger companies merge together, and they were able to rationalize their businesses and then set the stage for, again, accountable businesses going forward. Then we've got a number of the next level of mid-tiers, and then the smaller cap producers. We've seen some M&A transactions that have occurred over the last couple of years. And in fact, during COVID times, we actually saw the Chinese gold companies preempt a lot of opportunities in terms of taking over 2 or 3 different gold companies, and they utilized drones and virtual due diligence to acquire these assets. When you're a public company listed on a and an exchange, there's no way the board of directors of that public company are going to be in a position to say, yes, we will make this acquisition based on virtual due diligence and drones. We're not there yet. The Chinese were aggressive enough to do that. My view in all of these commodity businesses is there's a number of opportunities that I have seen, and we have relationships with investment bankers, and we understand what's sort of happening within that space. And I think there's a number of potential M&A opportunities that are upcoming. COVID has been a major factor that has precluded transactions to occur because of due diligence site visits to those various regions. Once COVID is behind us, or a number of restrictions on countries traveling into by potential suitors, I think we'll see a wave of M&A. That in turn, and today, when you're buying some of these mid-tier companies that we have very close relationships with, some of these companies have unbelievable growth profiles, trading at 0.5, 0.6 times NAV. These, when we talk about earlier in terms of the commodity opportunity and whether there's a super cycle or a cycle, these companies are trading, even though that we've had a move in commodity prices, these companies are trading at 5 times EV to EBITDA. When we look at the other parts of the market, like the technology space, where we're seeing opportunities and people saying, "Oh, this is really cheap. You're paying 10 times revenue as opposed to 20 times revenue for this other peer." We're looking and saying, "Well, we're buying these things for 4 times, 3 times." In one case, we have a base metals investment that's trading at 1.5 times EV to EBITDA. And we're in a market that's already started to get bullish. So, so in terms of where are we in the cycle, we have a long way to go here. Now, that long way could be short way, depending on how quickly the valuations move. But from that perspective, when we talk about, you answer your original question about gold, is these companies are cheap.
Yeah. A good value in the state of the market. But I think, do you think that some of that is to do with demand looking elsewhere in global equities, tech stocks looking so appealing, crypto, as you said, and then also lessons of the past, okay, it's taken a long time to get that reputation back that these companies can pay a dividend, run a tight ship, focus on the capital discipline that was expected in the last boom period.
I don't know if it's the lessons of the past. And the reason I say that is because I think there's a new generation of portfolio manager out there that necessarily wasn't exposed to what we saw in terms of bad behavior within the space. I think also that they haven't been educated within the space, but they are starting to get educated. I get, a number of the analysts that I speak to, one of the first questions I ask them when they call me goes, "Well, how's your marketing? What kind of interest are you seeing?" And then, one time I remember not long ago, one of my friends who was an analyst, and he was in New York, and said, I went into this meeting with this young guy who manages internet security and mining. He asked me, "Well, why doesn't this company just mine the nickel out of the ground as opposed to the copper, because nickel is twice the price?" As well, that's not how it works. So there's an education process that's required for these investors. So so where are we at in terms of why everything is about fund flows in the investment business. The fund flows have been in the tech companies and the growth related companies as opposed to value. We've started seeing some things come back to value. What one has to remember is that the resource space is a very small space. So when fund flows start coming in there, and in today's world, momentum and program trading starts occurring, that could have such a massive impact within this space that, then we'll be talking about, are we at the top of the cycle? And at some point in time that happens. We're not even close to being there yet, because we haven't seen any major fund flows come into this space yet.
Yeah, that's interesting. Yeah, I was going to ask your thoughts there. So it's still a lot of generalist capital on the sidelines, waiting or looking for the right timing to come back into mining.
Yeah, I think, again, we have to separate sort of precious metals and gold and the industrial metals, and industrial metals focus on. But I think in one of my commentaries, and I may be off on the numbers here, but I think we added up all of the market caps of all the gold companies in the world, and it was less than half of the market cap of one of the giant tech companies.
Yeah.
So it puts it in perspective in terms of what we're talking about here, in terms of the fund flows side of things. So when the fund flows, the generalists come in, it can come significant, but we have to remember here, there's not a lot of ways to invest in this in a really credible fashion.
Mm-hmm.
What will end up happening is a lot of that money will come into ETFs, which will get flowed into a number of these constituents of those ETFs. And then there will be the gap between the constituents and the valuations of the ones that are non-constituents, and then the M&A starts. So this cycle, as it comes, it'll probably come fast. And if we see consolidation, there'll be less and less ways to play it. So there will be required higher valuations.
Yep.
Result of that.
Okay, excellent. Just to cap off, Ryaz, just wanted to get your thoughts on, when the market looks good, when do you take profits off the table, or is it very much a case by case basis on, obviously, based on how long you've been in holding a company for, is the market really good right now? You're looking to deploy more capital rather than take a profit, take a return. So,
there's a number of ways to look at this in terms of taking a profit. For example, one of the oil companies we were involved with, we were the first entrants of this particular country in South America. We were involved with this company and management team that had the track record, and we invested alongside them, and the market cap was about $150 million at that stage. We ended up holding the company off and on as a major holding, but always holding it. And then 8 years later, the company was worth about $3 billion. And in that time, they'd only done one equity financing, and I can't remember the size of it, but it wasn't significant. So that was an unbelievable value creation. During that time, in the early years, there was no analyst coverage on it. Investment banks really didn't follow it because they didn't really need much money. But then all of a sudden, it became too hard to ignore. And then we started seeing analyst coverages and more interest in terms of the investment banks, in terms of marketing them, because maybe there was an opportunity to do M&A, and either way, them being the acquirer or them being acquired. And then what happened was that for me is my unique connection to that management team and my edge on that story had dissipated. Okay, so I didn't believe that the company could still be further successful, but we'd seen that transition, that cycle go to that stage, but we didn't have an edge over anyone else. And if everyone was bullish on it, then that was for us the time to exit in that standpoint. One area when it comes to the commodities that will be an indication that we're at the top of the market, and this is something we've done some back testing on, is there will be a valuation metric that is at the high end of the side of things that we'll see within the commodity space. And then that'll be something to watch out for. But then once analysts start dropping the absolute valuations and start going to relative valuations, then you know we're close to the top.
Yep. That's interesting. Yeah, that's good. Excellent. And well, that takes us pretty much to time. And Ryaz, thanks very much. It's been a really fascinating discovery of your process, your thesis, and also some of these really interesting secular opportunities within metals and mining. So thanks a lot for talking with us today.
Well, thanks very much, Adam.